So these are the factors that we need to consider with capital assets that tell us then how the asset is going to be treated. How long it's held. Capital assets as well are distinguished between whether they were held for 1 year or less or more than 1 year. They have different tax treatment. So that distinction is relevant for the business assets. It's also relevant for the capital assets. Whether the asset produced a gain or a loss. Capital assets that produce a gain are going to be reported, well, losses are going to be reported in the same place, but losses, as I alluded to earlier, are limited. Total losses are limited for capital gains. You can only take up to $3,000 of a capital loss in a given year, a total capital loss. Those capital losses offset other income on your tax return. But it's limited to only $3,000 in a year. So, and we're going to talk a little bit more about that later, but what happens when you have $5,000 of capital losses and you can only take 3,000 of them this year, that 2,000 then rolls over to the next year. And you can carry them forward forever. Used to be there was a limit on that amount of time you could carry them forward. There is not anymore. Okay, so we have to know whether or not we had a loss or a gain. There's no limit on the gains, by the way. The type of capital assets sold. So there are a couple of distinct types of capital assets. Now, in general, they're going to be all your personal use assets, all your investment assets. But there are a couple of subcategories of investment / personal use assets that have special tax rates. Collectibles are one of them. If you happen to have a collection of something, maybe a collection of stamps, a collection of coins, I think guns would probably fall under that, collection of figurines, I don't know, any type of collectible, and you sell them for a gain, they are taxed at a special tax rate. They've got their own tax rate. Collectibles do. Also, a special type of stock, if you own stock as an investment in a qualified small business and you sell it for a gain, it also has a special tax rate. We're not going to go into a lot of detail about what defines these qualified small businesses, but they have their own special tax rate. In addition, 1250 property is treated, like I said, it could go on the Schedule D. If it does, it's treated like a capital asset and it has its own special tax rate as well. Okay, so those are some subcategories. It essentially, this kind of becomes capital gain property, sort of. I mean, it's not really capital gain property, but for tax purposes, it then gets treated like capital gain property. And it's got its own special tax rate. The taxpayer's tax bracket is important for the same reason that it was important for those qualified dividends. And it's the exact same brackets that we used for the qualified dividends are what we're going to use for capital gains. They use the same cutoffs, the same tax rates. So 0%, 15%, 20%. Again, this is only for capital assets right now. So the taxpayer's tax bracket we have to know. Then what we also have to do, now oftentimes, we don't just sell one asset, right? Especially if we have stocks or bonds, maybe we'll sell some stock that has a long-term gain. And then we sell some other stock in the same year that has a long-term loss. And then we sell some more that have a short-term gain, and we sell some more that has a long-term or a short-term loss. So now we've got these 4 different categories of losses and gains for capital assets. We have to net them together. Okay, so we're gonna combine those, all of those together, but they have to be combined in a particular order. I already talked about the qualified small business. So it's a little bit, the capital assets are more complicated than the ordinary assets when we sell them. Okay. Just kind of a little recap. I know we started to talk about this, but. So, I already mentioned the holding period. So holding period for a capital asset more than 1 year or 1 year or less. The difference between the two is the tax rate that they are going to be subjected to. If you hold it for more than 1 year, you get the lower capital gains tax rates, which again are the same as those qualified dividend tax rates. If you hold it for a year or less, it is subject then to ordinary tax rates, which generally speaking are going to be higher. So you're kind of penalized for selling it early, but you're rewarded for holding it for a longer period of time. Let's see. These are the other tax rates. So that collectibles gain, I mentioned the collectibles, its tax rate is 28%. Which, I mean, if you look down here, the most, if it were taxed at the capital gains tax rates, the most it would be taxed is 20%, but it's taxed at 28%. 1202 gain, that's that small business stock. Unrecaptured 1250 gain, we're going to talk about that. This is attached to that 1250 property, has a special tax rate of 25%. Okay, so the tax rates, again, I'm not going to go into a lot of detail on the tax rates because you should already be familiar with this from your work with those qualified dividends. Same rates, same brackets, 0%, 15%, 20%. And this, we're going to talk about this, I'm just going to set this aside for right now. We'll talk about this when we talk about 1250 property. I don't know why I guess I know why they put this in here because, like I said, the 1250 property kind of takes on the characteristics of a capital asset. It ends up, if there's a gain, it ends up on that Schedule D, but I think this would be better placed in the section of 1250 assets. Let's see, I'm gonna do this. I talked about the collectibles and the 1202, the small business stock. There's an additional tax on, and this is related to, this came into being when Obamacare or ACA was passed. We had that additional Medicare tax that we've talked about, and if you think back to payroll, we've talked about that additional Medicare tax of 0.9% on, but that's on income, on wages. There's another tax called the net investment income tax, right here, NII. It is a 3.8% tax that is applied to income over a certain amount if you have investment income. So the amounts are pretty high. Again, these are for high earners, but it's only applied to investment income. So if you have, again, modified adjusted gross income and are married filing jointly, and you have net investment income, once you reach that $250,000 mark, then any net investment income over that amount would be subject to this additional Medicare tax, or this surtax, the net investment income tax. If you are single, head of household, $200,000. If you're married filing separately, it would be $125,000. So, but again, it's only going to be applied at amounts over that. That doesn't mean that you have to have net investment income over that amount. You could have $10 of investment income, and it could be subject to that surtax. if your modified adjusted gross income is over those amounts. Okay? So for example, let's say you're married filing jointly and you have your modified AGI is 270,000. And your net investment income is 50,000. So which is included in that 270,000. Only the amount over the 250 is going to be subject to the net investment income tax, the 3.8% tax. So we would take that 270 minus that threshold, 250, for married filing jointly. $20,000 of that net investment income is going to be subject to this this additional tax. So that's what would be multiplied by 3.8%. So essentially what you do is you take the total modified adjusted gross income, subtract the threshold that it starts to be applied, compare the result to the total amount of net investment income, whichever is lower is what you're going to pay that 3.8% tax on. Does that make sense? So $30,000 of this net investment income is not going to be subject to that additional tax. Still going to be subject to regular income tax. Okay? Questions so far? All right. This is the fun part. This is where you get to see Kelly struggle with explaining this. The netting of these. Just a second.